Chipotle and Snap on the move, both reporting earnings after the bell. We've got full team coverage. Josh Lipton's all over Snap's earnings call, but we begin with Chipotle. Kate Rogers got the details back at headquarters. Hey, Kate.
Hey, Melissa. Well, Chipotle out with a very strong Q3, beating on metrics across the board. Same store sales increasing by 11%, surpassing expectations from analysts for a 9.3% increase for the third quarter. This included 7.5% transaction growth. Digital, of course, has always been a big focus area for Chipotle. Take a listen to CEO Brian Niccol.
This quarter, digital sales grew 88% year over year to $257 million and represented 18.3% of sales during the seasonally slower summer quarter for digital. And we're knocking on the door of digital becoming a billion-dollar business.
The company's loyalty program, Chipotle Rewards, now has 7 million enrolled members, and Niccol said the company is really just starting to scratch the surface of leveraging all of that customer data. Chipotle said it could open slightly fewer restaurants than expected this year as it seeks more locations that can accommodate what it calls Chipotle lanes. Those are drive-through lanes for digital orders that are placed ahead of time. They're resonating really well with customers. It says it'll have about 60 lanes open this year, and that some of its 2019 openings could shift into early 2020 because these locations do have a longer construction time. Niccol also said that carne asada is performing well in stores, receiving positive customer feedback, and added that Chipotle is testing queso blanco in several markets, but they're not rushing to add any menu items. They really want to get these things right. Brian Niccol will sit down with us exclusively on the exchange tomorrow at 1 p.m. ET to recap the quarter and much more. Melissa, back over to you.
But effectively, Kate, in terms of their guidance, what they guided to is comp store sales at the high end of the previous range, correct? So they're not raising anything.
No. Yeah. Everything was basically right in line, but they sounded very positive and upbeat. And, there was some confusion around the store openings. Basically, they're saying that they'll just shift some of them into 2020 because those Chipotle stores will take a bit longer. So really kind of reiterating the guidance that was already there.
All right, Kate, thank you. Kate Rogers back at headquarters. Is reiterating guidance enough for a stock that has almost doubled for the past year?
Probably not, but I don't think this move to the downside is all that bad. And listen, I'm not going to pretend I've been on the CMG story because I have not. I mean, this has defied logic. But then if you look at it and say, this is one, you went to the Harvard. I mean, they're going to write about this in Harvard Business Review.
The Harvard Business.
I mean, what a great turn. I mean, they've really turned it around in a short period of time. Now they have probably, 30% EPS growth, does trade at a huge multiple. The only knock in this quarter, I think, is what you mentioned, and maybe operating margin slight miss. But I got to tell you, if they can't sell the stock off on the back of this quarter with the inline, to your point, the stock is going to go significantly higher again.
Well, I think expectations were really high going in, and maybe it was sort of a buy the rumor, sell the news, because they started selling it before the actual news came out. It was down $20 today, but it's run up $100, right? And so I feel like it was priced for perfection. They delivered near perfection. I mean, there was only the slightest flaws in that. It's just, for me, too expensive to own. I would have said that $200 ago.
Yeah. Everyone who's reported in this space, Domino's, McDonald's, Darden, everyone had trouble with comp sales. But when you look at this stock, it's been the outperformer. I love when digital sales are up. That was what made me buy Domino's. I love McDonald's when they work on digital sales. I love it, but not enough.
Other people don't love it, though, when they're investing in digital sales for the future.
It's true. There is a capital expense to this whole element of growth, but you need to invest in the winners. So I think you wait till this stock pulls back a little bit, and I'd be a buyer on some weakness. It has to pull back more so than it has already, obviously. Nothing. It has
McDonald's?
McDonald's, I think, is a buying opportunity because McDonald's is a staple. It's a safety bet. And when the market comes in, McDonald's usually goes up. I think you're getting a gift at McDonald's at this point.
All right, let's move on. Take a look at Snap. That stock lower after reporting results. Let's get to Josh Lipton with the details. Hey, Josh.
So, Melissa, just for a quick take from the street, I checked in with Aaron Kessler of Raymond James, has a hold on the name. His quick take on the results. Kessler's saying on revenue, fairly solid growth driven by North America. Europe, though, he emphasized, did decelerate. U.S. and Europe, he would characterize as a bit disappointing on user growth, just given, he said, the strength we saw from Snap back in Q2. Guidance, he would describe as relatively in line with estimates. CEO Evan Spiegel on the call, which really just started here, saying 210 daily active users. That's up 13% year over year. There was a clear path to profitability, he says. Talked about engagement as well. Says each daily active user opening Snapchat about 30 times a day on average. And finally, investment areas he would call out: scaling content, he says, and AR platforms. Melissa, back to you.
Josh, thanks. Josh Lipton in San Francisco. Snap, Dan.
You know, really interesting. Obviously, we've spent a lot of time this year talking about these tech companies that have been very disruptive, that come to the public markets losing money. This is a company, since its IPO in 2017, has been losing money. They're going to do $1.7 billion in sales this year, obviously growing at a pretty good clip, but on an adjusted basis, they're going to lose $300 million in net income. On a GAAP basis, $1 billion. The stock is up 150% on the year. To me, you know, with that sort of user growth that they have, it doesn't make a whole heck of a lot of sense to me. It comes down to possibly the scarcity value. It comes down to horrible sentiment last year, horrible stock performance, and maybe this company has turned things around, focused a little bit more on Android. But again, $19 billion market cap, they're losing money, and everything else that's losing money in disruptive tech is getting smeared.
You bought this today?
I bought it right before. I did the same thing I did.
Right before the close.
Right before the close. I did the same thing I did on Netflix. And I felt terrible about the Netflix trade immediately, and then I felt great after 4 o'clock. I don't feel so great with the stock down 3%, but I think I'm okay because the stock did sell off 26% since September. Snap, that is. So I think you're getting a little bit of positioning. The street got incredibly bullish as of late, and I think you're going to see a bunch of analysts protect the name tomorrow, so I'm going to stay in the trade.
Yeah, Guy?
I think it has room to 12.5. I mean, I hear what Steve is saying. I also hear what Dan's saying. You don't have the active user growth that you need, I think, to justify the valuation. And yes, it has sold off significantly since the middle of August or so. I still think there's further room to the downside. And fourth quarter revenue guidance was a bit disappointing in my book.
And the thing that's interesting to me is this became an IPO. We're trying to be an IPO today, right? I don't know that it would have this valuation. It would seem to me like that really wouldn't fly. So I don't know why. I still don't know why.
Well, it's still lower than its own IPO price. So it's still being valued lower than when it originally came out. And I think the market has done a good job. But I think Dan brings up an important point, the scarcity value of it. Then you have the opportunities internationally in India. You have ad dollars. So I think it's the guide that really hit it because it beat it on every other metric. So whether or not these are the right numbers or these are the numbers to grow, they beat estimates. Usually you see a stock run when they beat. You're not seeing that now. It's all about the guide to me.
All right, let's round out this earnings trifecta. Texas Instruments plunging after hours following its earnings report. Eric Chemmy's back at headquarters to break the results down. Eric.
Melissa, that's right. The stock down more than 9% in extended trading, but off its worst levels of the after-hours session. The chip maker missed on sales, calling out particular weakness in communication equipment as total revenues decreased 11% versus last year. Another big reason for the drop is weak guidance for the next quarter. Texas Instruments now forecasting EPS of 91 cents to $1.09 for the fourth quarter. Analysts had been expecting $1.28. Interestingly, the weak guidance comes after some recent encouraging signs of growth. The company just raised its dividend by 17% in September, and data earlier this month showed PC shipments rose for the second quarter in a row. Texas Instruments' downbeat outlook weighing on shares of other chip names, Intel, AMD, Micron, and NVIDIA. And something to note, according to Bespoke, the last time Texas Instruments opened down more than 8% in reaction to earnings, October 2008.
Wow. Eric, thank you. Eric Chemmy. You guys over here on this side of the desk were saying this is a very important earnings release.
I think it's hugely important. I mean, again, I'm shocked that Texas Instruments was trading north of 130 with a 24 forward multiple with probably, 9% EPS growth or so in this environment with so many unknowns. This guidance is not, I'm surprised it's not down more than it is right now. It should be a lot lower. It's still expensive. It's actually, you can make an argument now that it might be more expensive now than it was 2 hours ago. So again, I think Texan is too rich. I think this could be a bellwether name going forward. I think today, the market-wise, was a really weird day, and this just adds to the weirdness.
Yeah, I would just say that, I know investors, especially ones who are tracking cyclical tech, were very focused on this name for the better part of 2019. The management was giving guidance about where they thought they were in the cycle. I think a quarter or so ago, they thought they were like the 3/5 through the down cycle. So that's why the stock broke out last quarter in July when they gave guidance that you and I were sitting on the desk then saying, why is it up 7%? Because the guidance wasn't that good. The guidance they gave for Q4 from 128 consensus down to $1 at the midpoint is really bad. And if it comes in below that, the stock's going to be much lower. Like you say, it's going to be back towards 100 or something.
I mean, we're seeing the sentiment spill over onto the rest of the semi space. SMH, by the way, the ETF that tracks the semiconductor space, down almost 3% of the after-hour session. It was already just a couple bucks shy from its 52-week
But how much of this really is with headline about trade woes? How much of this really is about backward-looking concerns about customers cutting orders based on what they're seeing or the lack of clarity going forward? This was above all its moving averages. It just pierced all of them in one single stroke. It was up 36%.
You're saying it was just momentum?
No, I'm saying that I wonder how much of this going forward, if we're looking at a terrible story backward looking, but if the trade wars start to subside and you get a little more clarity, a little more confidence, is it more of an opportunity going forward to buy a discounted stock versus something else?
How far do we extrapolate?
I think we extrapolate.
In terms of technology?
Yeah, I do. For one, I mean, if for no other reason than the run has been, it's gigantic, right? And so we often see a lot of times somebody misses, everybody trades down on it, someone else misses, everybody again trades down on it, even though half that news has been out there already. I wouldn't be surprised to see that happen.
What is the extrapolation? Is there an extrapolation beyond semis?
Beyond semis. I mean, I don't know. Does this have effect on Apple? I mean,
autos, industrial
Right.
tech. I mean, it's not just
industrials this week, which we're going to hear from Caterpillar, Roper.
Did Texas highlight
Listen, here's the thing, and just back to your point about, listen, we saw a lot of ordering ahead of tariffs, that sort of thing, earlier in the year, that sort of thing. So, and listen, that could be one of the reasons why it got to where we were, and those results weren't even that good. So here's the thing, if they're wrong on where they were in the cycle, and we see a sputter here and then a downturn, then these stocks are all way too expensive. And I think if you look at Intel, which is stuck in the mud, in like the low 50s, high 40s, low 50s, all year long.
Right. The beauty of these things, though, Dan, is they trade as a group and they trade as one goes up, they all go up, one goes down, they all go down.
I mean, so
if we see a headline that's positive, this down 10% in Texan will be bought really quickly, and you could be dead right on all your fundamental analysis, but it doesn't matter.